Welcome to the New School of Super, a fresh look at money matters, your super, and the things that could affect your financial dreams now and in future, with Sun Super's Chief Economist, Brian Parker, and Head of Advice and Retirement, Anne Fuchs.
Hello and welcome to the New School of Super, Sun Super's podcast and webinar series covering investment markets, money matters, and making sure you achieve your retirement dreams. For those of you that don't know me, my name is Anne Fuchs and I head up advice and retirement here in Sun Super. And I'm actually here today on Turrbal and Yagara land. And before we begin, want to pay respects to elders past, present, emerging. And with me is my friend, who is also on traditional country, Brian Parker, our Chief Economist here at Sun Super. Where are you today, Brian?
I'm in the land of the Gadigal people of the Eora Nation here in Sydney.
Fantastic. Look, today we're going to be talking about investment performance. It's been a massive financial year for people. People will be starting to get their annual statements soon. It's really important. So we want to bring you up to speed on everything you need to know about your superannuation and how it's performed. But before we do that, we need to cover off the general advice warning, Brian. And I'm going to throw to you because you are really good at that, my friend.
Oh, thanks very much for that. That's my claim to fame. Yes, that's right, Anne. And as always, we need to let everybody know that what we're going to talk about today is general information only. Any advice doesn't take into account your personal situation. You should consider your circumstances and think about getting personal advice before acting on anything we discuss. You can also get a copy of our product disclosure statement from our website, or you can give us a call on 13 11 84.
That was beautiful. And if you think about financial advice,
so
I often say there is, I call it the holy trinity of retirement. It could reflect 12 years of education that I had from the Sisters of Mercy, but the holy trinity of retirement. And that is the low cost fees, like good quality product, great quality financial advice, and excellent, strong investment performance. And when you have those three things, you have the best shot of living your best retirement, which everybody deserves. You know, you work hard. And so I think to that point, let's talk today about investment performance because it's been a hell of a year, a hell of a year. And I think, many people would describe it as really challenging, but yet the performance would indicate it's been a great year in terms of markets. Tell us about that, Brian.
Yeah, you're right. It's really been quite extraordinary. And if you think back, really before the end of last financial year, we think back to March 2020 and just how dire the situation looked. Not just the COVID situation, which was increasingly dire, but also the investment situation. So you saw this incredibly sharp fall in global share markets during those few weeks in March. And the way I often describe it in talking to people is that it was kind of like having the experience of the GFC compressed into about 3 weeks, which was very, very intense. But really what caught everybody by surprise was the speed of the recovery in financial markets, that from really late March 2020, we've seen this incredible recovery in world share markets, which has really been quite staggering, partly driven by the initial success at getting the virus under control, but also the policy response, this enormous policy stimulus from the world's central banks and from governments to really inject liquidity and inject money into the financial system. And it really did help underpin the recovery in world share markets we've seen. In terms of performance, over the financial year to June 30, the Sun Super balanced option did 20.7%. That's
no
probably
one
the
would have
best
believed them if
financial
told
year
them.
performance. No. If we'd have been on this call a year ago and said we're going to do better than 20% for the year to June, nobody would have logged into this call ever again because we just simply wouldn't have been credible. But that's what's been achieved. 20.7% is probably, I think it's the best financial year performance that Sun Super has had in over 25 years, which is really quite extraordinary given the world that we've been in over that period.
And look, I think this is where I think you're right. People would have thought we were absolutely barking mad if we'd have said that, the old-fashioned vernacular my father would have used. But I think about those members who had financial advice in that period from March through to July in particular, who their advisors told them to hold their nerve, like do not do not sell down at this time, and what, as a consequence, they didn't. And there are lots of members that chose to sell down at that time and move to cash, which I feel really sad about. And so I think there's a real lesson in here, isn't there, around, when you're feeling uncomfortable about investment performance, calling your super fund and speaking to a financial advisor to get the full facts.
I think that's absolutely right. If you think back to what members did during that really intense period in March last year, there was two things that really stood out. Firstly, as you've said, those members that got financial advice or who had a financial advisor were much better placed and were much less likely to make poor investment choices in March last year. And the second thing is those members in the SunSuper default option were also much less likely to make poor investment choices. And that's really because the default option is designed to gradually reduce your risk, gradually reduce your exposure to world share markets in particular as you approach and then enter retirement. And what it means is that a lot of those members in the default who are in their 50s and 60s who might have otherwise chosen to panic and potentially make the wrong investment decision, basically stay put. And that's a really, really good thing, that the default actually did what it's meant to do. In other words, it looked after those members that are often disengaged with their super, but it pretty much ensured that members weren't taking too much risk at that particularly important part of their retirement journey.
There's a lesson in that, really. We've spoken about it before, Brian, about what happened in recent years, the level of interest in superannuation and people downloading their app and really tracking their investment performance. And look, I know I was even guilty at times of logging in every day or two just to see what was going on. But, arguably there were many of the disengaged, maybe younger people who weren't feeling financially insecure as a consequence of job loss, maybe weren't paying attention. And as such, the life cycle approach worked, or maybe someone older, that was true as well. But it is this fine line around paying attention to your super but making sure you get the right advice when all of it, particularly when investment markets are behaving in a very erratic way.
Yeah, absolutely, and it's something that we've said on this podcast series beforehand too. And I've called it the sleep at night test. Is that it's so important for people to have an investment portfolio and an investment strategy that suits their particular needs, that suits their particular phase of life, their long-term goals, and their appetite for risk. And I think that last point is particularly important because, as I said, I call it the sleep at night test. If you're doing something with money, anything at all, it can be your super or your mortgage or a small business loan or whatever. But if you're doing something with money which causes you to lose more than about 5 minutes of sleep at night, it probably means you're taking too much risk and you need to make some changes to your investment strategy. And I think it really takes a crisis such as March last year to really, I suppose, teach people, well, or at least it's a way of testing people's appetite for risk. If you went through a period like that last year and you said, you know what, I understand that these things happen, and at my phase of life, I've got many, many years to run to retirement. This is potentially an opportunity to contribute more to super because that'll enhance my long-term retirement outcome because I'm able to buy assets at a cheaper price. Well, that's great. That means that you were probably appropriately invested. But if you were really, really unsettled by March last year, I think there's the lesson in that to me is that maybe you're taking too much risk with your investments. And that's really what a financial advisor can help you deal with, to really, get an advice so that, you're properly invested, so that you have an investment strategy that suits your particular needs. I think that's just really, really important. And, that was a really major lesson for me from 2020.
One of the other things too, Brian, if I think about investment performance, and we had the ongoing early release, but equally it was the tale of two cities, metaphorically speaking, because we had lots of people calling on early release. It'd be good to talk about the impact that had on performance, but also too we had just historic levels of members putting money into super and with voluntary contributions too. So let's just unpack did the early release and those members who were feeling financially vulnerable and needed their super to live on, did that impact investment performance?
Not necessarily. I mean, it was a bit of a balancing act, if I could describe it that way, is that we knew relatively early on that we were going to need to maintain a very strong liquidity position in the fund. Initially, to ensure that those members that wanted to move from balanced and growth investments into cash, that we were able to accommodate that. So we made sure that we had sufficient cash reserves in the fund to deal with that. Then you had the early release scheme from superannuation. So we also needed to make sure that we had enough liquidity to meet those needs. And given that we are a very large profit for member fund with a national footprint, an overwhelmingly private sector membership base, and covering all industries, we knew that, and also having members that are relatively young. The average age of a Sunsuper member is about 36. So we knew that a good many of our young members were going to need to take advantage of that early release scheme. So we needed to make sure that we had enough liquidity to meet those demands. But at the same time, every financial crisis throws up opportunities. There's an old adage in politics, and as you know, that you never waste a good crisis. And in investment speak, a crisis such as March 2020 does provide opportunities to buy assets at beaten down prices. We needed to make sure that we had enough liquidity on hand to take advantage of those opportunities. And thankfully we did. So we were able to meet our members' demands for liquidity, but also make sure that we were able to take advantage of some of the opportunities that came our way during the crisis. But to be fair, I think given the speed with which things turned around, perhaps there weren't as many opportunities coming out of this crisis as we might have seen previously. But certainly there were some opportunities that we were able to take advantage of.
So how do you, a question for you, because there's this sort of investment jargon called dynamic asset allocation, which I think is probably worthwhile just explaining to members, because when you talk about taking advantage of an opportunity, it requires flexibility around where you're allocating money to invest. And so maybe if you could explain to our viewers and listeners, what's dynamic asset allocation as a philosophy or approach to managing money, and how is that approach used to take advantage of markets to then create an investment gain that members are the beneficiary of?
Yeah, that's a good question, Anne. From about early to mid 2019, we've been running a dynamic asset allocation program. And in short, what it does is that it looks at the valuation. It tries to assess what is fair value for a range of share and bond markets all around the world. And it compares the current price of those bonds and shares to what we consider to be fair value. And what it does is it tries to go overweight or tries to buy into those markets that look most attractively priced. In other words, where the price on offer in those markets is less than what we consider to be fair value. And the flip side of that is that those markets that we think are trading at prices that are over their fair value, we want to be a bit more cautious there. So we want to cut back our exposure to those markets. It also, at the overall fund level, allows us to take some active positions to add a bit of extra value, add a bit of extra performance through time. What we saw last year was that we went into the COVID crisis being a little bit overweight with our shares exposure. We thought that shares looked relatively attractively priced compared to cash and compared to government bonds, because as you might recall, even before COVID, the level of interest rates around the world was extraordinarily low. And so we certainly had the view that fixed income returns were going to be very, very low over the medium term. When COVID hit and share prices fell very, very sharply, we took advantage of that. We basically implemented our DAA strategy in a very disciplined and risk-controlled way. We did some buying. We bought Australian and international shares and sold further out of government bonds, both here in Australia and around the world. And that meant that we were very well positioned for the recovery. We were able to benefit from the very, very sharp turnaround in world share markets. I will not claim to say that we predicted the speed of the turnaround. Nobody did, to be very frank with you. But we were certainly well positioned for that turnaround. As 2020 progressed and as share markets continued to recover, we sort of cut back again. We took profits, if you like, on those purchases that we did during the depths of March 2020. So over the course of the year, that DAA strategy has added meaningfully to the returns of the fund, and that's very, very pleasing.
Is there a particular asset? Members love your stories. There was the the story about was it Romanian or Albanian supermarket?
I would say Albania, but yeah, we still do actually own equity in a Romanian supermarket chain, which is doing very, very well, continuing to roll out new stores. And yeah, that's been a very success. Not a massive investment, obviously, but it's one of these quirky stories that I do like to tell, because it just illustrates, what happens when you have the sort of global reach, if you like, of a major superannuation fund. But certainly we've seen our unlisted assets perform quite well over the last year or so. What we find with having a substantial allocation to unlisted assets is that you're not immune to a major downturn in the world economy. And certainly these assets weren't immune. We did have assets that fared worse than others, and we had assets that fared remarkably well. Airports being a case in point. So we did see the valuation on our airports, both here in Australia and overseas, marked down quite considerably. But at the same time, we had other assets in the portfolio that did really, really well. To all those people who are out there online shopping, thank you, because you added significantly to the demand for data center capacity around the world. So our data center investments did very, very well, as did our warehouse investments here in Australia. So industrial warehouse facilities have been in huge demand over the last year or more. And so those assets have done incredibly well for us. So while some assets have performed poorly, as you'd expect, other assets have actually been beneficiaries, if you like, of COVID. Another big issue, though, is that one of the things we found pre-COVID was that there was an awful lot of money around the world looking for a home. That with interest rates so low and a lot of liquidity sloshing around the world financial system looking to buy assets, we found that putting money to work, buying attractively priced assets was a challenge. We were able to do that, but it had become a big challenge. What we found is that all that money that was looking for a home, that never went away during COVID. And so what we found in the last 12 months in particular is that a lot of the assets we hold have been in huge demand. We've taken advantage of that by actually selling some of our assets in infrastructure and property. When we've received offers that we consider to be, shall we say, overly generous, too good to refuse. We're duty bound to have a look and to ask the question: is this, if someone offers what you consider to be a ridiculous price for an asset you own, you need to ask two questions. Firstly, what do they know about the asset that we don't? What are we missing? Could we extract better value out of this asset ourselves rather than sell it to someone else? And secondly, ask yourself, if we were to sell the asset, could we reinvest the cash elsewhere and get a better return? That's the sort of key test for us. And certainly we were able to sell some property assets here in Australia, but also the most notably, we owned Caruna, the electricity distribution network in Finland. We received a very, very attractive offer to buy our equity in that. And we're very, very happy to sell and reinvest the cash elsewhere. And in the process, booked very, very significant profits for members. That was a very, very good transaction to be involved in.
And what some of the themes I heard out of that, though, and certainly I've seen firsthand working and sitting side by side with you and the investment team, is the importance of diversification and the importance of stress testing and liquidity and cash flows. And seeing that come to life has been a privilege to sit by and watch you guys make some really hard decisions, but always acting in members' best interests. And everyone who's a member of Sunsuper should be feeling really pleased right now that their money's being with an investment team that really are a safe pair of hands. And so I'm going to now say, well, Brian, and I'm going to do this. You're an economist, I'm going to ask you to make a prediction, which I know you don't like doing. No, but wait. So what do members?
Oh no, she used to be.
Yeah, so you don't necessarily need to make a prediction per se, but what should members be expecting? They certainly probably didn't expect this level of investment outperformance. So what should they be thinking about now that it's been such a good ride because of the diversification, because of the level of stress testing those assets have gone through and all those things I said before? What's next in the chapter of superannuation and retirement savings at Sunsuper?
Look, I think there's a lot to unpack there, Anne. But look, firstly, you're right. Last year was an enormous stress test, a real world stress test for the way we invest members' money, and the fund passed with flying colours. We were able to meet members' demands for liquidity, but while also make sure that we position the fund for the eventual recovery and that very, very strong recovery in markets. And this comes from years of stress testing our portfolios to ensure that we can meet these very, very intense demands when crises do come our way. And thankfully, the demands of last year were well within the limits that we previously stress tested for, and that was really, really pleasing. Now, going forward, I think the main message is, should anyone do their planning assuming that we get back-to-back years of 20+% returns? No. I think the best, and I don't think anyone has a reliable crystal ball when it comes to predictions about the next 6 months, 12 months, for example. I just don't think you can meaningfully make investment decisions based on those kind of short-term market forecasts. There's no obvious reason to expect another crisis. There's no obvious reason to expect another recession. There's bound to be setbacks along the way. Being based in Sydney, we are in the middle of one as we speak. There will be economic setbacks. There will be setbacks with regard to the virus, with regard to the vaccine rollout. But what we can say is that when we look ahead, and there is a light at the end of the tunnel, and it's not a train, it is the end of the tunnel. Vaccines are a game changer. And even though the vaccine rollout here in Australia, for example, has been disappointing, the reality is that there is a light at the end of the tunnel. Vaccines are being rolled out, and that does mean that we can become more confident about the medium to long-term outlook for the economy. And if that's the case, it's, as long as you can be reasonably optimistic about the economy, it's hard to be terribly pessimistic about the outlook for share market returns, for example. And final point is, it's ironically easier to say things about long-term future performance than it is about the next 12 months. And the best indication I can give you is to say, let's look at what we put in our product disclosure statement. If, for example, for those investors, for those members in our balanced option, we are aiming to achieve 3.5% above inflation after fees and taxes over the next decade. That is our prime function as an investment team. Are we confident we can do that? Yes, we are. Are we finding assets and investment strategies that we can invest in that are capable of delivering those kind of returns members need? Yes, we are. We think that's an important message to get out there, that over the longer term, we want to make sure our members have a realistic idea of what kind of investment returns are achievable and sustainable over time. And those numbers are not 20% per annum. They're more like in the mid to high single digits per annum. That, to me, is a more reasonable expectation for members to have over the longer term.
Do you think a lot of our members who are in retirement view these webinars or listen to these podcasts? And I guess the question to you is really around assets and asset allocation. And obviously retired members do seem to are naturally drawn to security for all of the obvious reasons, and worry about, Australian shares used to be seen as maybe a bit more secure, fixed interest. Any sort of particular advice to those members who are in that drawdown phase of retirement that, they're not working anymore, so this money is all the more precious because they've just got no time to sort of make it up? What would you say to them, Brian?
First thing, please get some advice. Please call Sunsuper and touch base with one of our financial advisors to make sure the investment strategy you have is the right one for you. So that's first and foremost. If I can bring it back to investments, I think it is a balancing act. We want to preserve capital as much as we can when we retire, but we also hope to live a long time, and we want our nest egg to last as long as possible as well. And so that means that we want to make sure we've got enough defensive assets to provide that capital protection and to provide that income, but also have enough exposure to growth assets so that we can achieve the kind of long-term returns so that our money lasts. And so making sure that balancing act is right. The other thing is that this is where the unlisted assets that we hold in portfolios really do come to the fore, because they do provide very significant opportunities for income. especially during an era where the income you're getting from cash and term deposits and government bonds is really quite poor and is going to stay quite poor for at least the next several years. The Reserve Bank has made that abundantly clear. But the unlisted assets, particularly in things like infrastructure and property, most of the return that we expect to get from these kind of unlisted assets is income. And so having those in the portfolio enables us to still generate reliable income for the fund while not having the same kind of exposure to share market volatility. And we think that's an important component of the asset allocation, including for those members in retirement. And finally, and I'll come back to the default, if I may, the Sunsuper for Life strategy. Our retirement, for those people in retirement, that strategy aims to have about 10% of the portfolio in cash and the remainder invested in Sunsuper's retirement options. So it equates to having about 45% of your portfolio in growth assets and the rest in defensive strategies. To me, the reason we had that as our default is that it's a common sense strategy for those people for people in retirement. That's not a bad starting point. But again, everyone is different. The ideal portfolio for me in retirement is going to be different from the ideal portfolio for you, Anne, when you retire. How do we solve the problem? We get advice to make sure that we've got a strategy that suits us.
Yeah, I think we were looking at data here, member data, after I think it was probably July last year, and we were reviewing that data and those members that got financial advice. I'm going to call out to the young women here in particular, any young women, or if you have daughters or young women in your life, to let them know, those women who got some financial advice to help them manage their cash flow and budgeting. So look, it's all good to sort of spend money and have a good time, but those women that were just putting a bit extra into super and taking advantage of market volatility, buying assets while they're cheap, compounding interest, the data is really compelling in terms of those women who did that are much more likely to catch up with their male counterparts at retirement, because we know women are on average retire with half the balance of men. So I just wanted to call out too that in the spirit of promoting financial advice, that the data came out loud and clear around making good investment decisions, not only around asset allocation, but just spending your money wisely. And this is either the largest or second largest asset you'll ever own, and sort of don't ever regret not putting money in when you could have and wasting it. It's like putting on sun cream early at a young age. Once you haven't done it, you haven't done it, and then it's too late. And you don't want to get to that point when you've got to retire and wish you'd done something differently. So I think, Brian, congratulations to you and the team on behalf of all of the members and the Sunsuper staff for just tremendous, magnificent performance. You and Ian Patrick, our Chief Investment Officer, and all of the team, thank you.
You're most welcome.
You're supposed to say you're welcome. You're being very humble. Being very humble. And look, any questions that any members have, you can call us on 13 11 84. The website's also fantastic, and the app for information. We're here to serve you. It's our primary purpose. We have no other purpose to help you achieve your retirement dreams. Brian, it's been a good natter as always, my friend.
Thanks very much, Anne. Good to be with you. And everybody on the call, stay safe and well.
Yeah, stay safe and well. Thanks for joining us, and we'll look forward to you joining us again soon. Thank you. Bye.
This has been the New School of Super. For information and inspiration to help you plan your future, manage your super, and enjoy your retirement, visit sunsuper.com.au/The Dream Project. Or if you've got a superannuation or investment question you'd like Brian and Anne to discuss, then get in touch at newschoolofsuper.com for it to feature in one of our future New School of Super podcasts.